Hey there, fellow knowledge seekers. Get ready to unlock the secrets of building wealth through rental properties. We're diving deep into a book jam-packed with smart strategies for buy and hold real estate investing. Consider this your crash course, whether you're a newbie or a seasoned investor looking for fresh insights.
What's really interesting is that the book immediately jumps into the allure of rental properties, highlighting leverage as one of the most powerful tools in an investor's arsenal.
Leverage, huh? Okay, so it's not about having a ton of cash up front. The book uses a great example of a $100,000 property. You don't need the whole amount to get started, right?
Right. Imagine securing a loan for 80% of that price.
Yeah.
You'd only need a $20,000 down payment. That's leverage in action. Using borrowed money to potentially amplify your returns, it's like using a small amount of force to move a much heavier object.
But too much force could backfire, couldn't it? Like, what if the property value takes a dip?
Exactly. That's the double-edged sword of leverage. It can magnify profits, but it can also magnify losses. Say someone took out a 100% loan. If the property value drops even slightly, they could owe more than it's worth.
Yikes. So it's all about finding that sweet spot, the right amount of leverage for your comfort level, I guess. Speaking of which, what are some common ways to leverage when buying a rental property?
The book highlights a few options. House hacking is great for beginners. You use an FHA loan with a low down payment, sometimes as low as 3.5%, to buy a small multifamily property. Live in one unit, rent out the rest, and voila, you're on your way.
So you're basically using the rental income to offset your own housing costs. Pretty clever way to get started. What about other loan options?
Conventional loans are another route. Most banks want 20% down for rentals, but some may accept less, and some require more, depending on your financial situation. It's always a good idea to shop around.
The book also mentions the all-cash approach, even name-dropping Dave Ramsey. But it seems like they lean towards leverage as a more practical path, especially for those just starting out.
Yes, paying cash is great if you can swing it. But for most investors, leverage is a key ingredient to building a portfolio. The book even advises those paying cash to analyze deals as if they were using a loan, a way to make sure you're not overpaying.
Now let's fast forward a bit. You've got a few rental properties generating that sweet passive income. It's tempting to think about quitting your job and living the landlord dream, right?
It certainly sounds appealing, but the book throws in an important consideration: compound interest. It poses a question. Even if your rental income covers expenses, is quitting your job right now the smartest move for your long-term wealth?
Okay, compound interest. That's the concept of earning interest on your interest, right? Making your money work harder for you.
Exactly. It's like a snowball rolling downhill, gaining momentum as it goes. Think about it this way. You have $1,000 earning 10% interest annually. After the first year, you earn $100 in interest. The next year, you earn interest not just on the original $1,000, but also on that extra $100.
So the snowball keeps getting bigger.
Right. Now imagine reinvesting that interest every year for 30 years. Your account would balloon to over $18,000. But if you withdraw that interest each year, you'll only end up with $4,000 total after 30 years. That's the power of compound interest in action.
Wow, that's a huge difference. So even if rental income is tempting you to quit your job, hanging in there a bit longer and reinvesting those earnings could mean serious long-term gains. It's all about playing the long game.
Absolutely. Quitting too early might mean missing out on that exponential growth potential.
So we've got the power of leverage and the importance of long-term thinking. What about actually choosing properties? Does the book offer any guidelines?
The book lays out some specific buying standards. They emphasize multifamily properties, fourplexes, apartment buildings, that sort of thing, aiming for at least $200 monthly cash flow per unit after all expenses are accounted for.
Hold on, all expenses. We're talking about every single cost, right? Not just the mortgage, but also things like taxes, insurance, potential vacancy, and repairs.
Absolutely. It's about focusing on net profit, not just income. They also recommend aiming for properties priced at a discount, around 80% of market value. That built-in equity is a nice cushion to start with.
Smart move. The book also mentions forced depreciation. What's that all about?
It's the idea that you can strategically improve a property to increase its value. Sometimes simple things like fresh paint or landscaping can boost its appeal and justify a higher rental price.
Ah, so it's like giving the property a mini makeover to attract better tenants and higher rents.
Exactly. And their standard also includes aiming for at least a 3% annual appreciation after that first year. That steady long-term growth is what builds real wealth over time.
Okay, so we've got these buying criteria: cash flow, discount pricing, forced depreciation, and long-term growth. How does all this play out in the real world?
The book outlines a 10-year plan. The first 5 years are all about consistent growth, laying the groundwork for your real estate empire. The plan involves buying one property per year and diligently saving as much income as possible.
And they really hammer home the importance of increasing your savings rate alongside your rental income. Why is that so crucial?
It's about accelerating the snowball effect we talked about earlier.
Yeah.
By boosting your savings, you can acquire more properties faster, leading to even more cash flow that you can reinvest. It creates a powerful cycle of growth.
So by the end of year 5, you'd ideally own 4 renter properties and be saving a solid $2,600 per month. That's a pretty impressive financial position to be in.
It is, and that's where things get really interesting. Years 6 through 10 are when the magic of compound interest really kicks in.
Okay, I'm intrigued. What happens in this next phase?
Because your increased savings and cash flow, you can actually buy 2 properties in year 7 instead of just one.
Whoa, the snowball is picking up speed. So each year, you're buying more properties thanks to those compounded returns. It's like watching your money multiply before your eyes.
Exactly. And it just keeps building. The book mentions the possibility of buying 2 properties in years 7 and 8, 3 in year 9, and so on. By year 11, you could potentially be buying 5 properties a year.
That's incredible. But let's face it, not everyone gets excited about the prospect of becoming a landlord. Convincing your spouse or partner to jump on the real estate investing train can sometimes feel like an uphill battle.
Oh, absolutely. The book acknowledges this and offers some helpful tips on getting loved ones on board.
I'm all ears. My partner still sees real estate as more of a headache than a wealth building tool. Any advice on changing their mind?
First, become a real estate expert yourself. The more you know, the better you'll be able to address any concerns and demonstrate that you're serious. It's about building confidence and trust.
Instead of just saying, let's buy a bunch of rentals, I need to show I've actually done my research. Makes sense.
Right. And don't overwhelm your partner with too much information at once. Start slow. Focus on simple concepts first. The idea of passive income replacing a job can be a powerful motivator.
Okay, so maybe start with the dream of ditching the alarm clock instead of diving into depreciation schedules right away.
Exactly. And encourage your partner to learn alongside you. Share the resources that got you excited about real estate. You mentioned Rich Dad, Poor Dad.
All right.
That's a classic.
It is. It's all about sparking their curiosity and helping them see the potential.
The book also suggests connecting on shared values. How does real estate align with your goals as a couple? Financial security, travel, more family time. Connect the dots between real estate and the life you want to build together.
Brilliant. So it becomes our path to achieving our dreams, not just my real estate thing.
Right. And lastly, find common ground. Explore your partner's interests. Maybe they're passionate about eco-friendly renovations or having a positive impact on the community.
Great point. Finding that sweet spot where passion and profit intersect is key.
Now, once you got your partner on board, it's time to assemble your dream team. Real estate investing is a team sport, and you need the right people in your corner.
Absolutely. The book emphasizes the importance of finding experts who can guide and support you through the intricacies of real estate.
They start with the role of a mentor or accountability partner, someone who is already successfully investing in your local market.
Speaking of mentors, you've mentioned your own mentor, Kyle. How did that relationship come about?
It was actually a chance encounter. I met Kyle while helping my friend paint his house. Kyle was his landlord. I had just bought my first rental property and had tons of questions. Kyle was incredibly generous with his time and knowledge.
That mentorship sounds invaluable. What did you gain from that experience?
He taught me so much about the local market,
Yeah.
connected me with key professionals, and he even helped me secure private lending for a property that needed some work. It was a game changer.
Wow, talk about being in the right place at the right time. And it really highlights the power of actively seeking out mentors. They can be found through local real estate groups, networking events, even online platforms like Bigger Pockets. Okay, next up, finding the right real estate agent. The book stresses that not just any agent will do right. We need someone who speaks investor.
Exactly. You need an agent who understands the nuances of rental property investing, not just someone focused on finding pretty kitchens and bathrooms for homeowners.
So what are some key qualities to look for in a real estate agent who gets it?
They need to understand the investor mindset. Their focus should be on return on investment, cash flow, and analyzing deals from a financial perspective.
Mm,
Basically, they need to speak our language.
got it. What else? Responsiveness is probably crucial, right? The market moves fast.
Absolutely. You need an agent who's quick on their feet, readily available,
Yeah.
and proactive. And of course, they need a deep understanding of the local market, trends, neighborhoods, rental rates, the whole shebang.
So they're basically your local real estate guru. The book also emphasizes building relationships with lenders. Why is that so important?
Having multiple lender relationships, banks, credit unions, etc., gives you more options and leverage when securing financing. It's like having a financial toolbox at your disposal.
Makes sense. Now let's talk about contractors. The book mentions your own rather frustrating contractor saga. 6 calls, 4 appointments, 2 no-shows. That sounds like a major headache.
It was definitely a lesson learned. Finding reliable contractors who are responsive, skilled, and reasonably priced can be a real challenge. It takes time, research, and a lot of networking.
So the takeaway here is that finding good contractors is an ongoing process, not a one-time event. You need to constantly be building your network and vetting potential candidates.
Right. And the book mentions other crucial team members. An accountant, a lawyer, an insurance agent, a property inspector, maybe even a bookkeeper. It's like assembling your own real estate A-team.
Okay, we've got our team assembled. Let's talk numbers. How do we analyze a potential deal to see if it makes financial sense?
The book breaks it down into 4 key steps. The first is estimating the after-repair value, or ARV. That's what the property will be worth after you've made all the necessary repairs and upgrades. You can figure this out by researching comparable properties in the area that have recently sold.
Let's say we're looking at a fixer-upper that, with some TLC, could be a real gem. How would we determine its ARV?
You look at similar properties in the same neighborhood that are in good condition. Let's call our fixer-upper 123 Main Street. By looking at comparable properties, you estimate that once it's fixed up, the 123 Main Street would be worth around $120,000. That's its ARV.
Got it. Step 2 is figuring out the financing and the total cash needed to make this deal happen.
Right. Assuming you're using a loan, you need to calculate your down payment, the
Yeah.
loan amount, and the cash needed for things like repairs, closing costs, and any pre-rent holding costs.
Let's say we're going with a 20% down payment loan for a 123 Main Street. How would that break down?
Your down payment would be $24,000, 20% of the $120,000 ARV, and your loan amount would be $96,000. Remember, banks usually base the loan percentage on the ARV, not the purchase price, which might be lower. Then you add up all the other expenses, repairs, closing costs, and so on.
Okay, so we've got the down payment, the loan amount, and all those extra costs. What's next?
Step 3 is calculating the monthly mortgage payment. You can use those handy online mortgage calculators to figure this out. You'll need your loan amount, the loan period, typically 30 years, and the interest rate, which you can get from local banks.
And finally, step 4 is analyzing all the other expenses that come with owning this rental property.
Yes, some are straightforward, like property taxes and insurance, but others, like vacancy rates and repair costs, require more research and estimation. You need to dig deep and make sure you're accounting for every possible cost.
It sounds like this step is all about being a financial detective.
Exactly.
Yeah.
The book breaks down typical expenses into categories: mortgage, taxes, insurance, vacancy, repairs, capital expenditures, and property management, if you decide to go that route.
So we've got a good handle on the financial analysis. Now let's talk about the different types of rental properties out there. It's like choosing the right vehicle for our real estate road trip, right?
Exactly. The book really emphasizes the importance of having a plan and knowing what kind of rental property aligns with your goals and resources. Are you picturing a sleek sports car or a reliable SUV for this journey?
Huh. I'm thinking more of a sturdy minivan. Lots of space for growth and hauling in those profits. But seriously, what are our options?
The classic single-family home is a popular choice. It's familiar, often easier to finance, and can have good appreciation potential.
Those are the ones we see all the time, right? Your typical house with a yard, maybe a garage.
Right, but there are downsides. If the property becomes vacant, your cash flow takes a big hit, and there's less opportunity for economies of scale compared to, say, a multifamily property.
Okay, so let's talk about multifamily properties. What's the appeal there?
Multifamily properties range from small duplexes and triplexes to larger apartment complexes. The book makes a distinction between small multifamily properties, 2 to 4 units, and larger ones, 5+ units.
Why is that distinction important?
It all comes down to how they are valued and financed. Smaller multifamily properties are usually treated like residential properties, similar to single-family homes. Larger ones are considered commercial real estate, and the rules change significantly.
Interesting. So how are those larger properties valued?
Instead of comparing sale prices of similar properties, commercial properties are valued based on their potential return on investment, or ROI.
So it's not just about what the building is worth, but how much money it can generate.
Exactly. This is where the term cap rate comes in. It represents the ROI an investor could achieve without using a loan, making it a useful way to compare the profitability of different commercial properties.
Okay, so cap rate is all about income potential. What are the overall pros and cons of multifamily investing?
Well, multifamily offers economies of scale. You can spread costs like maintenance and management across multiple units, making them more efficient. And if one unit becomes vacant, it doesn't completely wipe out your cash flow like it might with a single-family home.
Ah, so it's like diversifying your rental income stream.
Right. But there are also downsides. Managing multiple units can be more complex, and the initial investment might be higher depending on the size of the property.
So it might require more upfront capital and a bit more hands-on management. It seems like each type of property has its own set of trade-offs.
Exactly. It really comes down to finding the right fit for your individual goals and risk tolerance. Now, regardless of which type of rental property you choose, there's one factor that trumps all: location, location, location.
Ah, the golden rule of real estate. Even the most amazing property can be a bad investment if it's in a terrible location.
Right. It's like trying to sell ice cream in the Arctic. The product might be great, but the market just isn't there.
So how do we evaluate a good location for a rental property?
The book talks about classifying locations into four categories: Class A, B, C, and D. Think of it like a grading system for neighborhoods.
Okay, I'm picturing a real estate report card. What are the key differences between these location grades?
Class A locations are the most desirable. High property values, low crime rates, strong tenant demand. Think upscale neighborhoods with great amenities and top-notch schools.
So these are the prime real estate locations, the ones everyone wants to be in.
Exactly. Then there's Class B, still a solid investment. They might have slightly lower property values and fewer fancy amenities, but still attract stable tenants. These are typically well-maintained, middle-class neighborhoods.
Okay, so still a good bet for rental properties.
Right. Then there's Class C, where things start to get a little riskier. These areas might have higher crime rates, more rundown properties, and less desirable schools. They can still be profitable, but require a more experienced investor who's comfortable navigating challenging situations.
Got it. So not for the faint of heart. What about Class D?
Class D is the avoid-at-all-costs category, unless you are a highly experienced investor with a high-risk tolerance. Think war zones, areas you wouldn't want to walk alone at night.
Yikes. That's definitely not the image I had in mind for my real estate empire. So we're sticking with A, B, or maybe C if we're feeling adventurous. Are there any other tools or metrics we can use to assess a location?
The book mentions the price-to-rent ratio as a helpful metric for evaluating the strength of a rental market.
Okay, break it down for us. How does this ratio work?
It's simply the median monthly rent in an area divided by the median home price. A high ratio indicates that owning is more favorable than renting, while a low ratio favors renting.
So if the ratio is high, it means you're getting more bang for your buck as a property owner compared to being a renter.
Exactly. It's a quick way to gauge the overall attractiveness of a rental market. Of course, there are other factors to consider: population growth, job market, crime rates, school districts, proximity to amenities. You want to look at the big picture.
What about vacancy rates? How do we find that information for a particular area?
There are a few ways. You can check census data, talk to real estate agents, or the best option, call local property managers and landlords. They have the inside scoop on which areas have high or low vacancy rates.
So it's like getting firsthand intel from the people who live and breathe real estate in that area. Makes sense.
Now let's talk about finding those hidden real estate gems, the deals that make investors drool.
I'm ready to go treasure hunting. But the book makes it clear that great deals rarely fall into your lap. You need to actively seek them out.
It's true. Finding those diamonds in the rough requires effort and a proactive approach.
So what are some effective strategies for uncovering these hidden gems?
Networking is key. Connect with other investors, real estate agents, contractors,
Right.
anyone who's plugged into the local market. It's all about tapping into that flow of information and building relationships.
It's like building your own real estate intelligence network.
Exactly. Then there's the classic driving for dollars technique. Physically scouting neighborhoods for distressed properties. You're basically a real estate detective, searching for clues.
Okay, so We're cruising around looking for properties with telltale signs of distress. What should we be looking for?
Things like overgrown yards, boarded up windows, notices of foreclosure. These can be indicators that a property is in trouble and might be a good deal.
Got it. We're on the lookout for those diamond in the rough properties that others might overlook. What other strategies does the book mention?
Direct mail marketing can be very effective. You target specific homeowners with tailored offers.
Ah, so we're sending out personalized invitations to join our real estate empire.
Right. And don't forget online resources. Websites like Bigger Pockets are great for deal analysis, networking, and finding potential properties.
So we're armed with our deal finding strategies. Now let's shift gears and talk about what to look for in a good rental property.
The book highlights a few key features. The number of bedrooms and bathrooms is a big one. More bedrooms and bathrooms generally mean higher rent potential. It's simple supply and demand.
Makes sense. More space, more tenants, more income.
Yeah.
Exactly. Off-street parking is another desirable feature, whether it's a driveway, carport, or garage. Tenants love the convenience and security of having a dedicated parking spot.
And of course, we can't forget about location, location, location.
Right. Proximity to amenities, good schools, and safe neighborhoods will always be in high demand. But here's something that might surprise you. Perfect properties often come with a premium price tag.
So are you saying we shouldn't be looking for those move-in ready, pristine properties?
Not necessarily. Savvy investors often look for properties with some quirks, challenges, or problems that scare away other buyers. These can be opportunities for great deals.
So it's about finding those hidden value-add opportunities, properties with untapped potential that others might miss.
Exactly. The book even calls them problem properties.
Yeah.
Not all problems are created equal.
Okay, let's talk about the good kind of problems versus the bad kind. What are some issues that you actually like to see in a potential rental property?
Cosmetic issues are a great place to start. Things like outdated paint, overgrown landscaping, or just plain dirt can deter most buyers, but they're relatively inexpensive and easy to fix. It's like giving the property a spa day.
So we're looking for those properties that need a little bit of cosmetic surgery to enhance their appeal?
Precisely. Outdated kitchens and bathrooms are another good problem to find. They can be updated to add significant value, but most buyers are scared off by the thought of renovations.
So we're looking for those properties that just need a little bit of love and attention. What else?
Deferred maintenance is another opportunity for a bargain. These are minor repairs that have been neglected. You can swoop in, fix them up, and add value. Overgrown yards are another easy fix. A bit of landscaping can instantly boost curb appeal. And vacant properties are often priced lower because the owner is eager to get rid of the carrying costs.
It's like finding a property that's ready for a fresh start.
Exactly. Even bad tenants can present a good opportunity. It might sound counterintuitive, but a property with troublesome tenants might scare away other buyers, allowing you to get a better price.
Wait, are you saying bad tenants can be a good thing?
Hear me out. You inherit the tenant problem, evict them, find responsible tenants, and turn the property around. You've essentially solved a problem and added value in the process.
Okay, so it's like turning a negative into a positive. What about hidden value add opportunities? What are some examples?
These are situations where you can make strategic changes to increase the property's value. One strategy you've mentioned is converting two-bedroom homes into three-bedroom homes.
Yes. It's amazing how much value you can add by simply creating an extra bedroom, and it often doesn't require a major renovation.
Right. And lastly, don't be afraid of junk. Properties filled with clutter or debris often scare off buyers, but you can secure a steep discount by cleaning them out. It's like turning trash into treasure.
Okay, so we've got a good grasp of the problems that can actually be opportunities in disguise. Now, for the flip side, the problems to avoid. The ones that can turn a seemingly good deal into a financial nightmare.
Absolutely. There are some red flags that should make you run for the hills. Foundation issues are a big one. They can be extremely expensive to repair, and they're not always obvious to the untrained eye.
So it's like a crack in the foundation of our investment. Not good.
Right. Major structural problems are another deal breaker. If the property needs significant repairs to the roof, walls, or framing, it can quickly eat into your profits.
So we're looking for solid bones, not a money pit.
Exactly. And roofing issues can be another major expense. A new roof is a big-ticket item that can really impact your budget.
Okay, so we're steering clear of those major structural or systems issues. But once we've found a property that meets our criteria, passes our due diligence, and gets us excited, it's time to take the plunge and make an offer.
The book compares making an offer on a property to proposing marriage. Both are nerve-wracking, but potentially life-changing events.
Huh. And just like with a marriage proposal, you never know for sure if the other party will say yes. But you have to put yourself out there if you want a chance at happiness, right?
Exactly. Now, let's break down the anatomy of a real estate offer. What are the key components?
Okay, enlighten us.
The most important document is the Purchase and Sale Agreement, or P&S. This is the legally binding contract outlining the terms of the sale, including the purchase price, closing date, and any contingencies.
So it's like the rule book for the transaction. What else?
You'll typically include an earnest money deposit with your offer. This demonstrates your serious intent to buy the property.
Ah, so this is where we put our money where our mouth is.
Exactly. And if you back out of the deal without a valid reason,
Hmm,
you could lose that earnest money.
got it. Now let's talk about negotiation. The book emphasizes that negotiation isn't just about the price. It's about finding a win-win solution where both parties feel good about the deal.
Right. It's not a battle to be won or lost. It's a collaborative process to find a solution that benefits everyone.
So what are some things we can negotiate besides the price?
The closing date, closing costs, any necessary repairs, contingencies, even appliances or fixtures included in the sale. It's a dance, and you're trying to find the right rhythm with the seller.
So don't get discouraged if your initial offer isn't accepted. It's all part of the dance.
Exactly. It's about finding that sweet spot where both you and the seller feel like you've gotten a fair deal.
Now let's dive into the world of financing options. The book explores a variety of ways to fund your rental property purchases, from traditional to more creative approaches.
They start with the simplest option, which can also be the most challenging, all cash.
Ah, the dream of skipping those mortgage payments. But as the book points out, it's not always realistic for new investors.
Right. While paying cash offers simplicity and avoids the risks of debt, it can tie up a lot of capital that could be used for other investments. It also brings up that classic debate, cash versus leverage.
The age-old battle. Fill us in. What are the arguments for each side?
The no-debt camp advocates for paying cash to avoid the risks and costs of loans. But the leverage camp argues that using borrowed money allows you to acquire more properties and potentially achieve higher returns.
It's like choosing between a slow and steady tortoise approach versus a faster, potentially riskier hare approach.
Exactly. The best path depends on your financial situation, your risk tolerance, and your investment goals. There's no one-size-fits-all answer.
The book then dives into private lending. What's that all about?
Private lending is when you borrow money from individuals instead of banks.
You shared your own experience with this, securing private lending through your Bigger Pockets network for a property that needed some work.
I did. I was able to find a private lender willing to fund both the purchase and the repairs, allowing me to acquire the property with minimal out-of-pocket expenses.
That's a great example of how networking can open doors to financing. So why would someone choose to be a private lender instead of investing in something like the stock market?
Private lending has a few advantages. First, the interest rates are typically higher than traditional bank loans, giving lenders a solid return on their investment.
Okay, so it's a win-win for both the borrower and the lender. The borrower gets financing, and the lender earns a potentially higher return.
Exactly. And because private loans are often secured by the property itself, lenders have more security than with other investments.
So if the borrower defaults, the lender can foreclose on the property and recoup their investment.
Right. For some lenders, it's also a way to help others achieve their real estate goals while generating passive income for themselves.
It's like being a real estate angel investor.
The book also briefly mentions other financing methods like hard money loans, home equity loans, partnerships, and syndications. There are lots of different ways to get creative with financing.
It sounds like we've got a whole toolbox of options, but let's talk about the traditional route, getting a loan from a bank. Any tips for navigating that process successfully?
The book does a deep dive into the loan process, revealing what it calls the secret to cracking the code.
Okay, I'm ready to unlock the vault. Tell us more.
The person you talk to at a bank is usually a loan officer, basically a salesperson. They aren't the one making the final decision. The real power lies with the underwriter.
The mysterious underwriter, what exactly do they do?
They analyze your financial information and decide whether you qualify for the loan. They are the ones who know all the rules, regulations, and risk factors that go into making that decision.
So how do we impress these underwriters and get that coveted yes to our loan application? What are they looking for?
Your credit score is crucial. Aim for a good score above 700 to show you're financially responsible. This will increase your chances of getting favorable terms. Your debt-to-income ratio, DTI, is also important. Lenders want to see that your debt is manageable compared to your income.
So it's not just about how much we make, but also how much we owe.
Exactly. A low DTI demonstrates financial stability and a lower risk of default. A larger down payment also reduces the lender's risk and often leads to lower interest rates.
So the more skin we have in the game, the more confident lenders will be.
Right. They also look at your employment history, preferring stable employment as a sign of reliability. And lastly, having cash reserves for unexpected expenses is important. It shows that you're prepared for those financial bumps in the road.
Okay, so we need to have our financial ducks in a row to get that loan approved. But what happens after our financing is secured?
It's time for due diligence, a thorough investigation of the property to uncover any potential problems or risks before closing the deal. Think of it as a real estate checkup.
Okay, so we're not just taking the seller's word for it. We're doing our own. Okay, so we're not just taking the seller's word for it. We're doing our own homework to make sure we're making a smart investment. What exactly does this real estate checkup entail?
Due diligence has several key components. First, there's the title search. This is where you trace the history of ownership to make sure there are no outstanding liens, claims, or other issues that could cloud the title.
It's like making sure the property has a clean legal bill of health, right?
Exactly. A title company or attorney typically handles this. They'll examine public records and legal documents to make sure the seller actually has the right to sell the property and that there are no hidden surprises lurking in the shadows.
Got it. What about the physical condition of the property? How do we assess that?
That's where a qualified property inspector comes in. They'll assess the physical condition of the property, from the roof to the foundation, looking for any structural, mechanical, or safety issues.
So they're giving the property a thorough physical exam to uncover any potential problems that might require costly repairs down the road.
Right. They'll inspect everything: the electrical system, plumbing, roof, foundation, looking for any signs of damage, defects, or potential problems. It's a crucial step in protecting your investment.
Okay, so we've got the legal and physical aspects covered. What else do we need to consider during due diligence?
The appraisal is another important component. This is where an independent appraiser determines the fair market value of the property. This helps ensure that you're not overpaying and that the bank is comfortable with the loan amount.
So it's a way to get an objective assessment of the property's worth.
Exactly. And lastly, environmental reports might be necessary, especially for older properties. These reports check for the presence of hazardous materials like lead paint, asbestos, or mold.
So we're making sure the property is safe for both us and our future tenants.
Right. Thorough due diligence can save you from a lot of headaches and costly surprises down the road.
It sounds like a crucial step in making a smart and informed investment. So let's say we found the perfect property, secured our financing, and sailed through due diligence with flying colors. What happens next?
The book emphasizes the importance of being prepared for your first tenant even before you close on the property.
Okay, so we're not just buying a property, we're launching a business. What are some key steps to ensure a smooth transition into landlord mode?
First and foremost, insurance. You need to protect your investment with the right coverage.
Okay, so not just any old insurance policy will do. What type of coverage should we be looking for?
The book highlights the importance of understanding the difference between actual cash value and replacement cost coverage. Actual cash value, or ACV, factors in depreciation, so you'll receive less money if you need to file a claim. Replacement cost coverage pays to rebuild your property to its current standards, regardless of depreciation.
So replacement cost coverage is like getting a brand new version of our property if something catastrophic happens.
Exactly. It's generally worth the extra cost to have that peace of mind. The book also mentions the importance of loss of rents coverage.
Loss of rents coverage, what does that cover?
If your property becomes uninhabitable due to a covered event, like a fire or major storm, this coverage reimburses you for the rent you would have collected during the repair period. It protects your cash flow even when disaster strikes.
So it helps us weather those unexpected storms, financially speaking. What about liability coverage?
Liability coverage is crucial. This protects you if someone is injured on your property and decides to sue. The book recommends having at least $500,000 in liability coverage, or even $1 million if you want extra protection.
Okay, so insurance is a must-have. What other preparations should we make before our tenant moves in?
Make sure all utilities are transferred into your name and that everything is functional. You don't want any surprises like a broken water heater or a non-working stove on move-in day.
Right. First impressions matter, even in the rental world. What about the security deposit?
The security deposit protects your investment from potential damage caused by tenants.
So it's like a financial cushion to cover any repairs or cleaning beyond normal wear and tear.
Exactly. And finally, you need a solid lease agreement in place. This legally binding document outlines the terms of the tenancy, including rent amount, lease term, and responsibilities of both parties.
It's like the rule book for the landlord-tenant relationship.
Right. A well-written lease agreement can help prevent misunderstandings and disputes down the road.
Okay, so we've got insurance, utilities, security deposit, and a lease agreement all set. We're ready to officially become landlords. But there's another big decision to make. Self-management versus hiring a property manager.
The book dives into the pros and cons of each approach. Property management can save you time and hassle, but it comes at a cost, typically around 8–10% of the monthly rent.
And it means giving up some control over our property. You mentioned a story in the book about a gutter repair that highlights a potential downside of property management.
Yes, a tenant reported a detached gutter. The property manager got a bid for $1,200 to fix it. I knew that repair shouldn't cost more than a couple $100, so I encouraged them to get a second bid.
And what happened?
The second bid came in at just $115. It just goes to show that even with a property manager, you need to stay involved and oversee the process.
So it's not a completely hands-off approach. We still need to be the CEO of our rental property business, even if we have a property manager on staff.
Exactly. Now let's look at self-management. What are the pros and cons of going that route?
I'm ready to weigh the options.
Self-management gives you more control, allows you to build closer relationships with tenants, and can potentially increase your profits by eliminating that property management fee.
But it also means a lot more work, right? We're responsible for everything.
Absolutely. You handle tenant screening, rent collection, maintenance, and any issues or emergencies that come up.
So it definitely requires a certain personality type and skill set.
Right. You need to be organized, communicative, and comfortable dealing with those inevitable landlord challenges.
Okay, so whether we choose self-management or hire a property manager, the book stresses that we need to shift our mindset and approach our rental properties as a business.
Yes. The book contrasts treating your rentals like a hobby versus running them like a well-oiled machine. They even share a story of an overwhelmed landlord drowning in tenant drama, late rent payments, and a never-ending to-do list.
Okay, that's not the picture of success I had in mind. So how do we avoid becoming that frazzled, stressed-out landlord?
It all comes down to establishing systems and processes, just like any successful business.
Okay, so we need clear procedures for everything, from finding and screening tenants to handling maintenance requests and collecting rent.
Exactly. Think of it as creating a real estate operations manual. It's about taking a structured, proactive approach instead of constantly reacting to problems.
Okay, I'm starting to see the difference between hobby landlord and business-minded landlord.
Yeah.
So let's break down some of these key areas where systems and processes are crucial. First up, finding and screening tenants.
This is where it all begins. You need a system for attracting qualified tenants and then vetting them thoroughly to make sure they'll be responsible and pay their rent on time.
Okay, so how do we attract those ideal tenants in the first place?
Marketing is key. Utilize online listing platforms like Zillow or Apartments.com. Post high-quality photos. Write detailed descriptions. And make sure your pricing is competitive. You're essentially creating a dating profile for your property.
Huh. I like that analogy. We're trying to make our property irresistible to those perfect tenants.
Exactly. You want to highlight its best features and make it stand out from the competition. Once those applications start rolling in, it's time to put on our detective hats and start screening.
Okay, so what does a thorough screening process entail?
The book emphasizes the importance of running credit checks, background checks, verifying income, and contacting previous landlords for references. You're leaving no stone unturned.
So we're doing our due diligence on potential tenants, just like we did with the property itself. Makes sense.
Right. It's all about mitigating risk and finding tenants who will pay their rent on time, respect the property, and be good neighbors.
Okay, so we've found our ideal tenant, we've signed the lease, and they've moved in. Now what? What are our ongoing responsibilities as landlords?
This is where clear expectations and those landlord responsibilities we discussed earlier come into play. The book stresses the importance of maintaining the habitability of the property, ensuring that it's safe and functional for your tenants.
Okay, so what does habitability mean in practical terms?
It means ensuring working appliances, plumbing, and heating systems. It means addressing repairs promptly and providing essential services like water and trash removal. It's about being a responsible landlord and creating a decent living environment for your tenants.
Got it. So we're providing a safe and functional place to live, and in return, we can expect our tenants to hold up their end of the bargain.
Exactly. You can expect them to pay rent on time, keep the property clean and sanitary, and report any maintenance issues promptly. It's a two-way street built on mutual respect and responsibility.
Now, let's talk about one of the less glamorous aspects of being a landlord: maintenance and repairs. Those leaky faucets and temperamental furnaces are bound to happen at some point.
It's true, maintenance and repairs are an inevitable part of owning rental properties, but the book advocates for a proactive approach, both to keep your tenants happy and to protect your investment.
So, what's the key to staying ahead of those maintenance headaches?
Preventative maintenance. It's much better to address potential problems before they turn into major, costly issues.
I like the sound of that. It's like giving our rental properties regular checkups to keep them healthy. What are some examples of preventative maintenance?
Things like annual furnace inspections, regular gutter cleaning, checking for leaks, and inspecting appliances. These proactive steps can save you a lot of hassle and money in the long run.
So it's about catching those small problems before they become big problems. And when those inevitable maintenance requests do come in, how should we handle them?
Respond promptly and professionally, even if you can't fix the problem immediately. Acknowledge the request. Give your tenant a realistic time frame and keep him informed.
Okay, so communication and responsiveness are key to keeping tenants happy.
Absolutely. Now, before we wrap up, I want to reiterate a crucial point that we've touched on throughout this deep dive. Approach your rental properties with a business mindset.
Yes, this idea of shifting from hobby landlord to business-minded landlord has really resonated with me.
It's a game changer. By creating systems and processes, managing your finances wisely,
Mm.
and treating your tenants with respect, you can turn those rental properties into a thriving business that generates passive income and builds long-term wealth.
It's about taking a strategic, organized approach instead of just hoping for the best.
Exactly. It's about being the CEO of your real estate empire, making informed decisions, and creating a sustainable business model that sets you up for success.
Well said. This deep dive has been incredibly insightful. We've covered so much ground, from analyzing deals and securing financing to managing properties like a pro, maximizing profits,
Mm.
and minimizing our tax burden.
It's been a whirlwind tour of the world of rental property investing.
As we wrap up this episode, I encourage all of our listeners to revisit those key takeaways and start putting them into action. Remember, knowledge is power, but action is what creates results.
Absolutely. Don't be afraid to take that first step, to do your research, and to start building your real estate dreams. The journey might be challenging, but the rewards are definitely worth it.
Well said. And remember, you don't have to go it alone. Build a strong team of advisors, mentors, and professionals who can guide and support you along the way.
And never stop learning and growing. The real estate world is constantly evolving. So stay curious, stay connected, and stay ahead of the curve.
That's a wrap on this deep dive into the world of rental property investing. Until next time, happy investing, everyone.